So every 6 months, someone tells you that the AI trade is over, the bubble is popping, and every 6 months they're wrong. This is the most common concern that I get when people think about investing in tech. These companies have run up so much over the last couple years. Can they really keep going up further? And in today's video, I'm going to be breaking down why I think the AI trade has multiple years left to run, what Nvidia's latest earnings tell us about the AI trade. I'll go over an AI prompt that I use to evaluate if a company is overvalued, if it's just trading on momentum, or if it can actually be a core holding in your portfolio. I'll break down a few of the companies that I've actually recommended on this channel and if they fall into the momentum category, core holding category, or if they're just overvalued. And most importantly, I'll be showing you what this actually looks like in practice for a sample portfolio, breaking it down in Portfolio Visualizer. And if all that sounds good to you, then you want to stick around. Let's get into it. So let's start with what just happened with Nvidia's earnings. So Nvidia just reported $81.6 billion of revenue in this first quarter. That's an 85% increase of their revenue year over year. And for a company of the size of Nvidia, that is not normal. That is an incredible growth rate. And of that revenue, 75.2% of it is coming from their AI data segment. So this is the GPUs, this is the Blackwell chips, this is their InfiniBand networking. All of it is just flying off the shelves. And the most important piece is that they actually revised up their guidance for next quarter. They're projecting $91 billion in Q2, which is higher than the analyst estimates for what they were expected to make. So they are making so much money that they actually increased their dividend from 1 cent to 25 cents per share. And they are planning a substantial $80 billion stock buyback. All of these things are not noise. This is giving you a signal. This company is growing at an astonishing rate, and it's primed to continue well into the future. And the thing to think about here is that they are not sacrificing their margins for all of this growth. They are still sitting at a 75% margin on all of their chips, all of their InfiniBand networking, all of their GPU clusters.
And so one good test on the AI bubble is to recognize that Nvidia has now millions of Nvidia GPUs in the cloud. We're in every cloud, we're used everywhere. And if you try to rent an Nvidia GPU these days, it's so incredibly hard. And the spot price of GPU rentals is going up. Not just the latest generation, but 2-generation-old GPUs.
Jensen Huang, the CEO of Nvidia, actually called this the largest infrastructure expansion in the history of humanity. And if you zoom out here, you can see what he's talking about. So in their earnings call, they actually projected that the annual AI spend rate is going to hit somewhere between $3 to $4 trillion per year by the end of the decade. And if you think about that in context of NVIDIA's market share, NVIDIA holds about 42 to 50% of that AI capex, which means NVIDIA is currently undervalued. And that also means anyone who's a prime contractor of NVIDIA or related to this AI trade is probably also undervalued. But how do you know? How do you know if something is trading on hype or if the fundamentals underneath support? So I want to share with you a prompt that I like to use. You can plug it into Gemini, you can plug it into Claude, you can plug it into OpenAI, Perplexity, your AI of choice. I personally recommend either Gemini or Perplexity. I feel like those two do the best job with financial based questions. But really, what I'm trying to answer is if a company can be a core holding that I can put in my portfolio and rest easy that it stays in there for multiple years, or if it's just trading on momentum and I should actually be concerned about its stock price cutting in half. And knowing the difference between core holdings, momentum plays, and just truly overvalued companies lets you decide on the actual portfolio allocations that you give to each of these companies. So I'll leave a copy of this prompt down below in the description, but you can use it. Just plug in the company name and it'll give you a snapshot, whether it's just trading on momentum or if there's actually underlying fundamental value that's driving that stock move. So let me break down the logic behind this prompt. So it's kind of divided into two parts, the momentum portion, and there's three things that go into momentum. So the relative strength index, the RSI, and this is trying to judge if the company is overvalued. So looking at that relative strength index, if it's over 70, that means that the market's gotten too excited too quickly and it's pretty overvalued and is probably going to correct downward. Then you have the moving averages. So it's telling you if there's short term or long term growth occurring inside the company based on where it is in relation to its moving average. And then we have the average directional index. So the average directional index is trying to show you the strength of the momentum of that particular company. So if it's above 25, then you know it has very strong directional momentum. And if it's below 20, you know that it's weaker or it's weakening directional momentum in that company. Then we have a portion that's actually looking at the fundamentals of the company. So you have the PEG ratio, the price to earnings growth ratio. And if it's less than one, then you know that it's undervalued and it's a good company to buy for the growth that it's experiencing. And then we'll look at the price to sales ratio, applying the rule of 20. So price to sales is a better metric to look at for companies that don't necessarily have positive earnings growth yet or pretty early in their cycle where their PE ratios might be negative because of their revenue still being slightly negative. So you can look at their price to sales. And if that price to sales ratio is greater than 20, then you know that it's probably overvalued. And then if it's under 20, then you know that the fundamentals are supporting the growth that's occurring. And then most importantly, we have to reconnect to reality and figure out what their forward guidance is. What is their competitive advantage in the market? And what is the story that is going to cause them to be a leader in this market or continue to grow through the rest of this decade? And when you plug this prompt in, it's going to do all this work for you. You don't necessarily have to think too hard about all these things because it will consolidate all this information down and it will put the stock in one of three categories. It will be a core holding, it will be a momentum play, or it will be overvalued. So I went and applied this prompt to some of the companies that I'd recommended on this channel. So Nvidia, as you might imagine, is a core holding with the pace at which they're growing their revenues, their essential monopoly as a GPU provider in the AI trade, and the $1 trillion plus revenue story not being priced into their company. Then Taiwan Semi, which is the premier semiconductor provider in the world, They too are a core holding. They have an essential monopoly. They're the only ones who are building semiconductors at the 2 nanometer and the 3 nanometer scale. And they're building out their capacity in the United States, in Arizona, and in Japan to expand outside of Taiwan. The growth story is real, and they have the bulk of the market share. Then we'll talk about Google. I've gone on record in the past and talked about Google being the one company that you should absolutely buy for the AI trade. And as you would imagine, they're a core holding. They have exposure to all 5 layers of the AI cake. They have plays in infrastructure, chips, the models, the applications, the actual energy. They actually bought Intersect Energy to supply some of their data centers. Google is a holding, and they've diversified their revenues across multiple industries. They're working on self-driving cars. They have the user base to support consumer. They have enterprise clients. Google is a core holding. ASML, they have a monopoly on extreme ultraviolet lithography. Those are the machines that you need to use to build semiconductor chips at those smaller nanometer scales. They screen out as a core holding. Broadcom's the same way. They're the alternative to Nvidia. They screened out as a core holding. Another under the radar pick as a core holding is Sterling Infrastructure, because they actually have a substantial backlog of AI data centers that they're going to construct. Their price to sales ratio is phenomenal, and they look primed to continue their growth well into the future. Now, there's a few that I would consider momentum plays, and AI considers momentum plays. So Lumentum falls into this category. They are the ones that are doing the networking solutions. SanDisk is a momentum play. I feel like they are getting a lot of the carryover memory demand that SK Hynix can't meet. More recently, Micron just passed the $1 trillion mark. And that is just because of the demand on memory is so high that any memory provider, even some of these older names like SanDisk and Micron, are experiencing extreme demand. But as SK Hynix builds out their capacity, they will be the premier provider. Bloom Energy is also a momentum play. Bloom Energy provides fuel oxide cells to power AI data centers. So one of the bottlenecks that AI companies are running into is that they have to wait 1 to 3 years to actually get power supply to their data center. This is where Bloom steps in, and they provide fuel oxide cells to those data centers, getting them powered up within 3 months. So the key takeaway here is you got to know what you're buying. You have to know what you're actually putting in your portfolio and do the analysis to figure out what the allocation size should be for the companies that you're purchasing. Okay, so we're going to be doing the analysis of what this looks like in practice. We'll be using one of my favorite free tools, Portfolio Visualizer. I'll be leaving a link to it down below. And I actually did an entire video on how you could set up these portfolios. You can check that out. But I went through all the different metrics, what you should be considering, which optimization you should be using. But in today's video, I'm just going to be trying to show you in practice what it looks like to do a mix of core holdings and some of these momentum plays. So if we look at this portfolio optimization tool, we're going to leave pretty much everything the same at the top here. We're going to click this benchmark, and I like to benchmark against the S&P 500. That's one of the options that you can select. And then I went ahead and I plugged in a bunch of the names that I like to use in a portfolio. So this Vanguard Information Technology, VGT, It's a technology focused ETF that tracks like a tech index. It's not quite the NASDAQ 100, but it's pretty close to the NASDAQ 100. Then I have Nvidia, which I said was a core holding. I have Taiwan Semi, which I said was a core holding. I always like a small asymmetric investment towards Bitcoin. In any portfolio that I build, just a small 5% allocation. I have gold in there. IAU is the one that I used here. You can actually use GLDM. That's another alternative to IAU. It has a slightly smaller expense ratio. And then I put Lumentum in there. I have Broadcom in there, Bloom Energy, and Sterling. So Lumentum and Bloom Energy are both momentum plays. And then we said that Broadcom and Sterling are going to be core holdings. I did put some constraints. So I wanted to maintain at least 10% of my portfolio in the index so it is diversified enough. And then I don't want my portfolio to go more than 5% Bitcoin. And I don't want my portfolio to be mostly gold. If you do a straight maximization for Sharpe Ratio, a lot of times it tries to make almost 50% of your portfolio gold. We're trying to get some growth here. So I just put a 25% max weight on gold just to limit the volatility. And then we're going to hit optimize. So then when you optimize, it's looking at a time frame from 2019 to 2026. And you can see that it kind of does the heavy lifting for you. It is giving you the allocations of each company that in the portfolio to maximize your risk to return. That's what that Sharpe ratio is. It's looking at the volatility compared to the returns that you're getting from the portfolio. And it's trying to maximize that. And you can see that the companies that were momentum plays are actually already starting to become smaller holdings in this portfolio. The only thing that's a little out of whack is that Lumentum, we said, was a momentum play, and it is almost 11% of this portfolio. So looking at that result, I would go back up here and I would adjust to get that a smaller weight in my overall portfolio, knowing that I've screened it out as a momentum play and not a core holding. So we'll go ahead and cap that at 7%, and then we'll optimize again. And now we have something that's more in line with what we assess. Lumentum is a momentum play. It's only 7%. Bloom Energy is a momentum play, and it naturally put it at almost 2%. And then all the things that we said could be core holdings are making up the bulk of our portfolio. So let's see what the return profile actually looks like for this. So the starting balance was $10,000. And you can see that that $10,000 would have turned into almost $250,000 over about 7 years. So that's very, very good. Obviously, past results don't guarantee future results. And none of this is financial advice. This is just a sample portfolio to show you how you could do this analysis for yourself. But you can see that the return profile is very, very strong. And then if we look at our worst year, our max drawdown numbers, they compare very favorably to the S&P 500. We're not actually taking that much more risk than just holding a straight up index fund. And then the most important thing here is the Sharpe and Sortino ratios. So the higher the number, the better. And you can see that our risk adjusted returns are substantially better for the portfolio we just built compared to just holding the S&P 500. One last thing I wanted to point out, because this is something that I don't think I discussed in my first video, is this efficient frontier graph that the portfolio optimizer gives you. So ideally, you want your portfolio to fall on this efficient frontier line, and it shows you the standard deviation at the bottom and the expected returns on the y-axis here. So Bloom Energy, you can see it has a very high expected return, but it also has a very high standard deviation. So it could boom or it could bust. And that's why it's such a small portion of the portfolio and why the optimizer used only 2% of it. Then you can see Sterling and Nvidia are actually pretty close together on this efficient frontier. Bitcoin has a bit more risk to it, but has similar expected returns. Broadcom, a little bit lower expected returns. Taiwan Semi, a little bit lower expected returns. But that standard deviation, that volatility is less. And then one of those key core holdings, our actual ETF, our index, those expected returns are even lower, but that volatility is also even lower. And then we have our gold, which is way at the left here. This is the thing that we're putting in the portfolio to try and control the overall risk in our portfolio and make everything a bit smoother. And this is kind of an image that I like to have in my head to know, okay, if I am buying more of this company, what am I actually buying? What level of volatility should I expect? What level of returns could I expect? So it's a nice little snapshot to kind of think about that. So I've thrown a lot of information at you, but there's three main things that I want you to take away from this video. The AI trade is not over. It's not anywhere close to being over. In fact, I've made this mistake in the past. I was up over 200% on Nvidia in 2016, and I assumed that there was no path for it to continue growing. I ended up selling, and honestly, if I had just held, if I was doing this analysis back then, I would be $1 million richer right now. Don't make my mistake. AI CapEx is expected to expand to almost $3 to $4 trillion by 2030. And there are some names that are undervalued right now that are going to be part of that growth story. And there are some names that are just trading on hype. Do the analysis and figure it out. And then most importantly, don't just go on vibes. Use an actual tool like Portfolio Visualizer, analyze it for yourself, build an optimized portfolio, and you should be making more sound investments because it's backed by math and not just vibes. And most importantly, and this should go without saying, none of this is financial advice. You have to make all these decisions for yourself. And I would never recommend just YOLOing into a completely AI portfolio. You should have a strategic allocation, which is a well-diversified index fund, bond fund, gold, mixed between international, domestic, and that should stay the same regardless of market conditions. And then for a small tactical allocation, a small 5 to 10% allocation of that overall portfolio, you can swing for the fences and build out a portfolio like I showed you with Portfolio Visualizer. And if you got something out of my video today, it gave you some ideas about how you could actually implement this AI trade in your own portfolio allocation, like the video, subscribe to the channel, because I'm gonna be trying to make you 1% better every day. Thanks for tuning in, and I'll catch you next time.
Stay in the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money, making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.